Hi, I'm Andrew Chambers and welcome to another week of Subject to Finance on the Monday the 19th of February. Hope you've all had a great start to the week this morning. Today I'm going to start with a little bit around what's going on with swap rates. So in the last week or so we've seen a bit of a rapid rise in some of those forecast interest rates in terms of the swap rates looking out 1 through 5 years. And we've got this sort of quandary at the moment of seeing the start of rates coming down in terms of those public rates offered by the banks, but the swap rate move up. So we're going to talk about what's going on there and what could it mean. So to start with, let's think about the wholesale rates going up. And I've been giving this some thought because I wanted to sort of figure out how I could explain it to you as an audience. And things that can push rates up are numerous, but what I've sort of been thinking is that, like with insurance where you have a natural disaster, we had one last January, and we all see a 20% increase on our premiums, the same sort of thing happens with debt. So if you have a credit default, someone can't repay their debt, that loss makes its way into the system and has to be made up somewhere else. So it often gets made up by pushing up interest rates. So higher risk markets mean higher rate markets. So there's a correlation between the rate and the risk. And so what we might be seeing here a little bit at the moment with these swap rates and the overall wholesale rates index moving up could be a function of what's going on in the world. And I've been looking at the situation in China with one of the largest property developers in China and major problem, major strife, and coming under more and more pressure to wind up. In fact, they've been put through the Hong Kong courts and told they have to wind up. We haven't really seen a bailout in terms of the Chinese government just yet. And they've got a heck of a lot of debt sitting there, one of the largest balance sheets on earth. So things like that, and that's not the only one going on out there in terms of global credit risk or default risk. Things like that naturally would have a tendency to push overall wholesale rates up. So that was my sort of thinking on explaining why that could be happening. There are other things. You take money out of circulation, rates generally go up. So there could be other things happening like that. But nevertheless, we've got the situation now where wholesale rates have been moving up, and yet, as a lot of you will have seen last week, we saw the likes of Westpac take 10 basis points off across the range in terms of their home loan rates. We've seen Heartland come out with an offer at 6.69 fixed for 1 year. And just even today, we've seen BNZ push up its LVR tolerance to 95% for certain lending. So what we've kind of got at the moment, I think, is an industry in terms of our local banking industry that really want to get new loans onto their balance sheets and are desperately trying to find ways to sell them over their competitors. So whether that's interest rates, cashbacks, or terms, they've been very generous in general across all of them. Yet on the flip side, they know that there is a bit of pressure upwards there in terms of the wholesale rates, and they know that they've got a Reserve Bank that's still really focused on getting that domestic inflation down. So it's a real balancing act, I think, for lenders at the moment when it comes to those big banks, because on one hand they've got their own position, their balance sheet, and ultimately their income to worry about, but on the other hand they're managing wholesale rate movements, an unstable global economic situation, and working alongside our own central bank in terms of the RBNZ and its inflationary goals to get that domestic inflation down. So where does that sort of leave us? My personal opinion on this is it still leaves us in a good position in terms of bank appetite for credit, where there are borrowers out there that can afford the interest rates at the moment. Their access to credit is actually going to be very good because there's a lot of appetite to increase the balance sheet of the banks. On the flip side, we are still in a high cost environment. As I've just said, inflation's still not coming back enough. RBNZ hasn't seen unemployment go up enough, and that makes it harder for some of those low-income families to justify borrowing or borrowing more. So we really are in a challenging position. I'd be interested in your thoughts. Please put your comments below as to what you think's driving these things. I'm just one person. It's really interesting to hear others' thoughts, whether you think that global defaults could go up and could drive rates up, whether you think that the OCR is going to go up because the RBNZ's not seeing the results it needs in terms of unemployment numbers and a dampening down of domestic inflation. I'd be interested to hear your comments below. Yeah, so just recapping this week, that's my little rant. Other than that, we've talked about the other side of it in terms of what's going on with the banks. Really competitive at the moment, competitive on cash, competitive on terms. You know, we're not going to see another dropout on rates like we did last year from ASB. They just can't afford to do that. They lost too much business. So no one's wanting to sit on their hands too much at the moment. They want to write business. I see that tied to really good valuation on property at the moment, and a lot of new property coming to the market just in the last month as ideal when we look at where we're at in terms of some of those measures coming back from investors to be able to get back into the market. So I expect to see investor sales in terms of residential going up over the next 6 months or so. I also expect to see offshore sales going up. And I think, you know, it's not all bad news for first home buyers still, in that interest rates, while they're a little bit higher, are being offset by really affordable entry-level housing. So, and that stock base in terms of that entry-level housing has been growing as new developments get finished. So, yeah, it's really interesting times, but not all that negative. I think there's a lot of positive in there for New Zealand Inc. If we can just weather the storm of some of the things that are going on around us offshore. And yeah, I do still think that there's going to be some downward pressure on interest rates. It's just not going to be big chunks like we've seen on the way up. It'll be the odd 10 basis points here or there in order for one bank to be a little bit more sweeter than their competition. Anyway, have a great week, and we'll talk more next week. Cheers.